you can't make a decision in a vacuum, nor can you make a decision at any one point in time without considering what the future looks like. Because if you think that we're going into a recessionary environment or we're going into an environment with high interest rates, it might make sense to be a tenant.
Who's this? Oh, you're an entrepreneur? Oh, you're a real estate investor. Oh, you're trying to learn from those who did it. Well, come into the lab then. Put your white coat on, gloves on, notepad, and let's build, y'all.
Real estate experiment. What is happening, y'all? Today I have the pleasure of having my brother from another country that I love so much, Canada, Chad Griffiths, here in the building with us. What's going on, Chad? How you doing, man? Thanks for coming to the lab with us.
I'm doing so well, Ruben, and I'm so glad to be on the show. And I'm excited to talk all facets of industrial real estate. Maybe we can talk some Edmonton, because you've been in Edmonton, which is rare. There's not a lot of people that have been in my neck of the woods. So it'll be an exciting conversation. I'm looking forward to this.
It's roles reversed on this side, because at the time of this recording, Chad, it is currently 7 degrees in New York, and I'm thinking like, all right, man, I got to make sure I don't drop how warm it is over here compared to Edmonton. And lo and behold, it's 19 degrees where you're at. So I'm feeling some type of way right now, because I feel like when I'm there, it's hella cold. When I come here, it's warm. So what's going on, man?
That's so crazy that you say that, because I think 19 is about room temperature, right? So in Fahrenheit, I'm guessing that's around 70. And this is very unusual for where I'm at to see this type of weather. And you're right. I've been to New York, and there's been times where New York is 20, 30 degrees warmer than where I am. So it is interesting to be on the opposite side of that today.
Absolutely. But I got to welcome you in, and I got to give you the introduction that you deserve, because you're being in a very niche space. And I always say, there's the riches are in the niches, and you're definitely in a niche of its own. And I really want to highlight that, because you come from the industrial space, and I definitely want to give your kudos as far as you have a very deep layered education background in the space. And I love that, because the reason why we have this show and this platform is to educate ourselves. So now you're hearing it from the Professor Griffiths here, who you have, this is key, because I know this stuff. I don't know if everybody else appreciates it, but I appreciate it. CCIM designation, that's no small feat. SIOR as well. Do you want to tell them a little bit of background on what that is? Because I really want to just separate yourself from the pack within the space. It's really appreciative of I appreciate what I see in your background. So just give us a little bit of context of what those designations mean for you and what it means for you and your clients.
Yeah, thanks for teeing that up so well. So CCIM is pretty much the main curriculum for commercial real estate investing. So it's a pretty extensive process to go through. You've got to complete a number of courses. You've got to show that you have a certain amount of experience, and then you have to pass a pretty comprehensive exam. So I got that in 2007, actually, which that's crazy to think about. That was 14, 15 years ago now. But that was really, thank you. It was really instrumental in just helping me analyze deals and see how things are. Like, kind of the main overview that I like to tell people about is it's really focused around the time value of money. So the principle of discounting, take out future cash flows, which is prevalent in commercial and even residential real estate investing. You're trying to build out a pro forma and bring all those numbers back to a single present value. And depending on what you use as a discount rate, you'll eventually come up with either a net present value, or you can also work in an internal rate of return calculation. And I don't want to confuse anyone that hasn't gone down that rabbit hole of discount and cash flow analysis, but it really is a very powerful tool. And I was fortunate to learn that early in my career. So CCIM is a great avenue. Another one is the REFM, Real Estate Financial Modeling. It's a professor, Peter Linneman, and one of his former students that put the course together. It's a much cheaper option and is a very similar curriculum. I would encourage anyone, if you just want to learn more about real estate investing, take one of those courses, and it'll be an eye opener. It certainly was for me back when I went through it. And then the other one is the SIOR, which I got in 2017. That one's more about the network. There's SIORs all over the world. That one's more production based. So you have to meet a certain threshold in production for 3 consecutive years before you're even eligible to apply for it. So I got that in 2017, and that's just a great network. There's some awesome brokers all over the world that I've been very fortunate to connect with just from that single organization.
Got to give credit where it's due. And with that, so what I love is that you it's theory, but then you practice, you preach what you practice and practice what you preach, right? It's one thing to have in the books, right? You got your MBA and you got Urban Land of Economics undergrad as well. I mean, you are literally putting in all the deep roots. I just talked about you just came off of a 200-person kind of a panel. So you're breathing, you're touching, you're in this space, but you're in a very particular space, and that is industrial real estate, which is very interesting, Chad, because yes, I've had a few storage guys come in, which I know is kind of an arm and a leg of what you're going to, introduce to us. Because I know there's about 3 verticals, which only one comes to mind for me. And I had to educate myself before I connected with you. But you're in a very, very unique space. And I really want to highlight that because we haven't had really anybody else who's been in the industrial space aside from the few storage guys that we had, which were super awesome guests on different episodes. But I'm excited because you have a wealth of knowledge on this topic. And so I got to ask you, when someone hears industrial real estate, right? The only thing, I'll tell you what I think of, but then I want you to fill some gaps. I think of warehouses because of the whole, and I look at it at a macro level. Like I'm thinking, okay, like Amazon, warehouses, which we're going to talk about the marketplace. I'd love to hear what your insight is about that. But what else are people not thinking about when they're saying industrial that they need to also add to the umbrella?
Yeah, I loved how you explained that, because you're right. Even when I started, so I got into the industry in 2005, and I had very little knowledge about industrial real estate either. I wish I would have actually journaled it at like the day one when I started, just to like write down how little I knew about it. Because unless you have reason to know about industrial real estate, it works in the background. These buildings are typically put away in industrial parks, which are off the main road. So unless you have a reason to be going into these industrial parks, there's no reason for you to actually know a whole lot about it. So much like you, I was very green when I first started, and you have some preconceived notions on what industrial real estate is. So I kind of just thought the same thing. It's probably like a building where you go to take your car, like an auto mechanic shop, and that's just the place that you have it fixed at. Incidentally, that was one of the first properties I ever sold was an auto mechanic shop, but it's much broader than that. And it's funny, in 2005, when I started, very few people knew much about industrial real estate at all, because Amazon wasn't big at the time. So there weren't these big warehouses there. But now you fast forward to today, and I'm sure even in New York, there's warehouses in major thoroughfares on major roads. You might see 1 million square foot warehouse building with an Amazon logo on the outside. That's all pretty new. Like that's within the last 5 to 10 years. So it's definitely come a long way in the last 15 to 20 years, where we're probably all talking about it now, right? You're talking about supply chain issues and how there's not enough warehousing space. You're in a market that has sub 2% vacancy rate. So I'm sure that's the talk of the town, where companies can't even find warehouse space right now. But I always like to break industrial real estate into 3 categories, because there are overlaps and there's things that are common between them, but there's also some distinct differences. So the categories I usually break them into: warehousing, manufacturing, and flex properties. So the warehouses people are pretty familiar with now. I like to use the example of a Costco or a Home Depot, which everybody's been in. These are essentially just large warehouses. Like if you go into them, there's very little retail build out. That's mostly just warehouse with racks and racks of storage all the way throughout the whole building. That's essentially just a warehouse. In a non-retail setting, like in a Home Depot or a Costco would be in, the buildings are very similar. Product comes in, they're stored. So it could be in racks of storage, or they could be in specific areas. But the whole idea is that there's product that's just stored for some period of time, and then it gets shipped out to the end customer. That's warehousing. The manufacturing side, which most people don't have as much familiarity with, just because it's not top of mind for them, is still a massive business. So these are all the companies where things are made. It could be raw materials coming in, it's assembled, manufactured, produced, put together, like a computer, as an example, is technically a manufacturing component, and then that end product gets shipped out. So those would be the two main ones, the manufacturing and warehousing. The third category, I typically group everything into flex, and that's an industry term, and is another way to look at it is just miscellaneous. That's all the properties that are technically zoned industrial. So they have an industrial classification from the municipality, but they're not necessarily conducive for warehousing or manufacturing. And that's where you start seeing a number of different uses. And I can guarantee in New York, you've got buildings that are zoned industrial that are used for art galleries, churches, showrooms. It can be self-storage. I usually would group under that as well, even though those ones can typically be retailer, other classifications as well, but a lot of self-storage is an industrial, and car dealerships, like really anything where there's some sort of work happening in the building, but it's not necessarily warehousing or manufacturing. And a good example is a building where we actually have our office. We have a building that's zoned industrial. The city has it as a business industrial zoning, but our office is in there, and our office is 100% office space. Even though that's an industrial building, it's 100% office. So that's a true flex property when you differentiate it between manufacturing and warehousing.
So, Chad, I mean, thank you for that distinction, and because I think I can appreciate it. And as you're speaking, I had so many questions that are firing because you're mentioning Costco. As I'm thinking now, I was in Brooklyn, and there's a place where literally it's just waste management. It's huge, right? And one of the things that I just can't stop myself from asking now, as you start talking about Costco, I started picturing all these things. In your space, just because in case I didn't highlight this, you're obviously a real estate broker and a partner. So you're a top producer, you do this at scale, you see transactions going in and out. Does a Costco typically buy I guess in this case, it would be a warehouse, or do they lease it? Like, I'm just trying to understand, what's happening around us as you're speaking this through, because I think it'll be important how we distinct how this marketplace even operates at that scale. Like, what do the Home Depots and Costco's of the world do? Do they buy their properties, or? Yeah,
and that's a great topic to explore as well. So those ones would traditionally be considered as retailers from a business standpoint, even though the buildings that they're in resemble a warehouse. Those ones would traditionally be like a retailer.
Oh, interesting. Okay. Because I was thinking like high ceilings. I don't, is that, yeah. How do you even, what is this distinction actually? Is it just has to be zoned that, or like what makes you call something industrial? I guess start there.
It's a great question.
I'm firing you from all sides.
I love it. I am literally willing to answer any single question you have about industrial estate. So there's nothing offside in my world. I would say that from a building standpoint, those are designed as warehouses. Like they'd be very easy to retrofit those to be a distribution center, even though they're going to be in a retail location. It probably has a retail zoning on it as well. Those ones would be considered retail classification, even though it looks like a warehouse. I would say that to really identify an industrial property it's the duck test. I said this in a video the other day. If it walks like a duck, looks like a duck, sounds like a duck, it's probably a duck. Well, if an industrial property looks like an industrial property, it's zoned for industrial purposes, and there's an industrial use inside, then it's probably an industrial property. But there's certainly some overlap, and there's some areas where it becomes a little bit gray, because you might have an industrial building that looks industrial, that's zoned industrial, but it's used by a retailer, like a flooring store might be a good example, where they've got a showroom in the front and then a warehouse in the back. That might be a retailer that's actually in there. So
it's like a Home Depot, right?
Yeah, and that's another natural example as well. So you're spot on with that. I would say that those examples don't come up nearly as often in practice, because the majority of ones are it's just black and white, right? Like it's a building that's used for a warehouse. It's a company like FedEx that has a big distribution center, and it's very clear that one is exactly an industrial property. But there are areas in that gray area where you do come across properties that is not as crystal clear.
Got it. So going back to the question, I guess in the marketplace, when we see this, because I'm curious as to hear how they work. And so does a Costco typically look? So would they find someone like you, Chad, to help them find a location for their facility, or are they actually developing from the ground up and saying, oh, this is the area where the demand is, we're going to build from the ground up?
Yeah, every company is going to have their own strategic operations on how they pursue this, but the vast majority of large companies that I've dealt with prefer to lease. And that, like, Amazon is a good example. Amazon leases the majority of the properties that they're in. All these fulfillment centers all over the world, they actually lease. They're starting to change that. There's some rumblings that they're going to start trying to buy more of their own properties, but historically they've been a tenant, and that was a very intentional decision where they didn't want to tie up all the capital in the building, but instead wanted to use the funds that they would have had to put for a down payment or whatever money they'd have to sink in as owners of the building. They instead chose to look at it from a lease perspective, where they don't have to put any money out of pocket, and they could in turn use that money to develop the business. And intuitively, I think that makes sense, right? If you're a shareholder of Amazon, you want them maximizing the return on their equity. The money that they have in the bank, you as a shareholder don't really care if they own real estate or whether they don't own real estate. You just want them to maximize the return on your investment. And for the most part, big companies tend to think that they can outperform real estate by investing in new markets, new product lines, growing the business organically. There's a lot of reasons to think that you can make a better return with Amazon going to another market than they would owning their own real estate, which by and large is going to just keep pace with inflation. That's an oversimplification, but from the standpoint of looking at the market as a whole, real estate quite often is going to move somewhat in line with inflation. So you as an investor are going to want Amazon or whatever company that you're considering to simply maximize their return on what money that they have. So a lot of these big companies intentionally lease for that reason. But there's also good reasons to purchase. If you know that you're going to be in that building for a long time, there's all sorts of tax incentives to buying the property. You've got control over rent increases. You're not going to have to be facing a large rental increase when your lease comes up. If the market does really well, if you're in a really robust market, like someone that bought warehousing space in New York 10 years ago would be feeling pretty confident right now. They're probably pretty happy that they made that decision. So there's pros and cons to it for sure, but it usually just comes down to an investment decision as opposed to a decision about, well, I don't want to be a tenant. I don't want to pay rent. I really want to be an owner. At the bigger level with this institutional money or institutional grade companies, they typically look at it on where can they make the best return on their investment. And if it's real estate, then they're going to pursue real estate. If they think they can deploy that capital in other mechanisms or investment vehicles that will give them a bigger return, then they're typically going to pursue that.
Yeah. So it sounds like opportunity cost is definitely what they're looking at. So let me ask you, and you let me know if any of these questions are kind of out of your scope, because I'm seeing that you're covering a large umbrella, but I'm assuming as a broker, let me ask you this first. As a broker, do you find yourself selling more of these as with respect to the current marketplace, or helping people buy into those, or more kind of helping people get into the leasing part? Like, when you look at your kind of scope of work on a day-to-day, if it was a pie, how much percentage of which is your daily activity? So I think that might give us some context as to what's happening in the marketplace.
Yeah. And I can also speak to that through the lens of investor, because I started building my own portfolio in 2014. So I've got some ownership of industrial properties as well, but I would say it's largely market driven. So if you're in a market where you're in historically low interest rates, which we still are in, even though the Fed's just increased the rate 25 basis points, we're still in a historically low interest rate environment. That looks pretty tempting for companies that want to deploy some capital to take advantage of low interest rates. So, but conversely, if we see 100 or 200 basis point increase in interest rates, and I don't even want to fathom what that does to the market as a whole, but if we start seeing upward pressure on those interest rates, I think more people will consider being tenants. So it moves, it ebbs and flows. That's the biggest thing that I say to companies, is that you can't make a decision in a vacuum, nor can you make a decision at any one point in time without considering what the future looks like. Because if you think that we're going into a recessionary environment or we're going into an environment with high interest rates, it might make sense to be a tenant. But if you're still bullish on the long-term prospects of the market and you can see that the market is going to be higher 5 to 10 years out now, or at least that's your investment thesis. If you believe that, then I still think it's a good time to buy. I've always taken the position that irrespective of whether you want to be an owner or whether you just want to lease, you need to look at real estate as a conduit to functioning for your business. The best thing that you can do is look at real estate as just a vehicle. It's a place where you're going to conduct your business, but it's a small component of your business. There's all the other additional things that you have beyond your real estate. So you really just want to make the best decision that you can for your business, irrespective of whether you want to be an owner or a tenant. Just find the best space for your business. And if you only want to be a tenant, well, then you're just looking at spaces for lease. But if you want to consider buying, don't ignore all the lease opportunities as well, because people often get too fixated on wanting to own, right? It's like ingrained in us as a culture, and particularly in North America, right? That you've got to own. You got to own your own house. So you got to own your own building, you got to own your real estate. And quite often, a lot of companies become fixated on that and they'll only look at options available for sale. Whereas there might have been a better building for their business that's only available for lease. So I always advise people that you need to just make the best decision for your business, regardless of whether that's a sale or a lease opportunity. Just make the best decision that you can for the business.
Got it. So, and I appreciate you kind of giving that from the lens of an investor. Now, and I'm glad that you're on both sides too, because I was going to lead with that question to see if you double dip. I love double dipping. So, but as far as you're currently in the Alberta market, is there any other markets or just?
I'm just in Alberta, but I actually follow North American markets quite extensively, just because there's a ton of overlap. Like what happens in New York is going to happen in Toronto. It's going to happen in Chicago. It's going to happen in my market. So that's so interesting. Yeah. Even though I'm focused myself as a broker and an investor in Western Canada, I follow the market pretty extensively. Like I at a reasonable level, I can tell you what's happening in markets in major markets all across North America and even some globally, just because I think there's so much overlap and similarities between markets when it comes to industrial real estate.
Yeah, and maybe some correlation there too, which we'll get in a second. But I'm curious, in Alberta, where do you find yourself doing the most of as far as like real estate brokerage activities? Do you find yourself selling more, helping people buy more, or lease more? Or actually, again, going back to the pie graph, like do you think it's a 33% and 33% split evenly across the board? Do you find that marketplace, out of curiosity, knowing Alberta, where are you seeing a lot of the transactions happening?
Yeah. So for those who aren't familiar with Alberta, we're very similar to Texas. Like we've got a heavy exposure to the oil and gas industry. So as a result of that, we have a lot of manufacturing space. Whereas, a market like New York, you're going to be predominantly warehousing space for good reason. Everything's coming in through the port. So it really ebbs and flows with market conditions. So as we went through this last commodity cycle of oil prices going from $140 a barrel in 2013 down to $30 a barrel a couple of years later, that had a pretty big impact on the manufacturing side. And for that reason, you could be busy one year doing a bunch of leasing, trying to backfill spaces. Then the next year you could be busy selling these properties, which have now been stabilized. So it ebbs and flows. I probably spend 80% of my time in leasing right now, but that's been reversed in other years too. So there's no rhyme or reason. I wish I had a crystal ball to say I should be focused just on sales this year or focus just on leasing. There's so many market dynamics at play that anything happening. And going back to the earlier point, anything that's happening in New York or the world, the global economy is going to trickle down to every market on a micro scale. So I wish that I could forecast how this was all going to play out and say, okay, this year is going to be busy in sales, so I'm just going to focus mostly on sales. It can vary month to month even. So I know that's probably not the best answer to give in terms of giving some real clarity.
That gives great context actually, because I think it's actually important for people to realize that in your space, it's all relative to what's happening in the marketplace. And so it's reactive as well. And so that's great. I guess, Chad, what I was going to ask too is, how long then are these leases typically?
So most large, it really increases with the size. So if someone's leasing 100,000 square foot facility, like FedEx comes in and they want to lease 100,000, or Amazon comes in, they want to lease 1 million square feet. Those will typically be 10 to 15 year leases. That's pretty average. You might see some that even stretch to 20 or even longer in some rare cases. 10 to 15 is pretty common, and they'll have options to renew from the tenant side. So the tenant can exercise an option to renew for another 10 or 15 years. That's a pretty common arrangement in those larger ones. Typically, the smaller that you go, and that's a great point to emphasize as well, is that industrial real estate isn't just about all these 100,000 square foot facilities. The first industrial property that I bought was a small industrial condo, and I paid about $400,000 for it. And that's the price of a house, right? And in some cases, that's even less expensive than a house. So the market is broad. Like, there's the full spectrum from a $400,000 condo like the one that I bought, all the way up to, there's a $250 million sale actually in your neck of the woods last year. The Mormon church actually bought a building that was leased to Amazon. 900,000 square foot building leased to Amazon. Mormon church bought it for $247 million. So
what are they doing out there? A church?
Well, the Mormon church bought it, but Amazon's the tenant.
Oh.
The Mormon church has more money than any of us would really realize. They are flush with cash, and they are a large player in the commercial and industrial real estate space.
No way.
Yep.
That's crazy.
So I don't have Mormon money. I'd like, but by any means, I'm not as nearly as well financed as the Mormon church. But they expand on that question you asked as well. The last tenant that we put in our small 2,000 square foot condo, we did a 2-year lease on. So it can range. There's some.
I'm surprised by that. I'm really surprised. I was expecting you to say 5 to 10, 15 to 20. That's like a mortgage.
It is. It's a long-term relationship. I tell people all the time that there's industrial leases that last longer than the average marriage. It's a long-term commitment.
Oh man, that's a tough one, y'all. Shout out to Celine, y'all. I'm getting married this summer. So
congrats. That's exciting, man. Where are you getting married?
In the Cape Cod.
Oh, that's awesome.
Massachusetts. So, but yeah, no, that's a funny statistic right there. So interesting. So 15 to 20 years, again, average, could be more or less. You said 247 million was what it was worth. What is that? I'm just curious, if I'm trying to do the math here, what does an overhead look like per month for, like, let's say 100,000 foot? I'm just trying to wrap my head around it. Like, what does that number look like? Is that like, we can use some range? Yeah,
we could use some quick math on this. So let's even just round it up to 1 million square feet, just for easy numbers. I don't know the New York market nearly as intimately as I know mine, but I think it's reasonable to say that they're probably paying $5 a square foot. So when I say $5 per square foot, that'd be the amount they pay per year. So call it $5 million a year that they're paying just in the net rent. So we break that down. What's my math on that? 400 grand a month.
Okay, yeah, that's
400 grand, and then on top of that, they pay property taxes, they pay building insurance. I mean, that's really the beauty of industrial real estate, is that these leases are structured that all those property level expenses get passed through to the tenant. So Amazon,
is that triple net? Is that what
triple net? Yeah, exactly. Lease? Yeah, exactly. So that is what a triple net lease is. Like, you nailed it. It's the tenant pays the net rent, or the base rent. In this case, I'm just ballparking, $5 a square foot, but they also pay for property taxes, building insurance, common area maintenance. So New York still gets some snow, not as much snow as we get, but still some snow. So there's snow removal costs in there. There's landscaping costs in there. All the property level expenses, and any increases in those also pass through to the tenant. So I'm willing to, I'd guess that Amazon's probably paying another couple bucks a square foot for those costs. So you could easily say that building is costing Amazon $8 to $10 million a year. And that's going to be in the $600,000 to $800,000 a month that they're paying just for that building. That $800,000 a month is going to the Mormon church. Mormon church is bought that.
So if we're talking, and again, I hate to, these are just averages because the average listener here is, we've heard multifamily apartments, we've heard short-term rentals, we've heard, they understand. We don't really talk about fix and flipping too much here, but we understand scale. But this is a whole different kind of product here we're talking. So I'm just trying to put a little bit of context behind these numbers. So if I'm buying something like that, and if I'm honest, I don't even know what 100,000 feet looks like. Is that like what is if for context and listeners who have been to Home Depot, Walmart, Target, what is that square footage, just for context?
So I can give a really good example on this. So an acre is 43,560 square feet. That's just a nerdy number that I've memorized from early in my career. That's an acre, 43,560 square feet. And an acre of land is roughly the size of a football field, less the end zones and 10 yards. So your brother would get this example really well. You'd know this intimately. Yeah. That's about an
Even
acre.
though the CFL has a wider field than
they do. Yeah.
You gotta call that out, y'all, if we're going to be correct.
Well, then the end zone is 100 yards in itself. Yeah. So, but the football field, that's roughly an acre. So take out the end zones and 10 yards. That's about 40. Let's just round it down to 43,000 square feet. So if you take 100,000 square feet, you're essentially looking at 2 full football fields under one single roof. That's 100,000 square feet.
Is that what a typical Home Depot would be, or is it smaller? I'm just trying to fit it into
range. It can range from about 150. These big box retailers are between 150 and 250,000 square feet. So you're easily looking at 2 to 3 football fields under one single roof at a minimum. If you get up to an Amazon facility, and these are 1 million square feet, in some cases even larger than that, it's actually hard to even wrap your head around how much space is under one continuous roofing system. It's incredible. Like when you walk through a building of that size, you feel very, very small. It's the equivalent of like looking up at the Empire State Building, but instead of looking up, you're just looking down.
What? All right, hold on. So let's just go, because that's too large for me in my head to even think about.
It is.
I can picture walking to a Walmart. We all can picture walking to a Costco, right? Let's stick with the Costcos and Walmarts and Home Depots of the world, right? So let's say 150-ish, right? It could be more or less, guys. We're just trying to come with some numbers. What would that cost me to buy?
Well, in the example with that Amazon one that sold to the Mormon church, they paid $247 million for that one. And that one was
$1 million.
That was about 900,000 square feet. So it really depends on the market, how hot the market is. Like a property in New York is going to be a lot more expensive than in the middle of Kansas, just because their land is scarce in New York. So people are paying a big premium for that. So I would give a range, like on a low end, you're probably paying, like at a very low end, $30-$40 a square foot. You could easily be paying up to $150 to $200 a square foot in some ultra hot markets. So it's like it really depends on every individual market, and the rents reflect that too, right? Like a Walmart or Home Depot or Costco will be paying less rent in the middle of Kansas than they would be paying for rent in a property in New York.
And I'm just doing the math here. So just for context, let's say you're in the 30-40 range. That's about $4.5 million. But if you're in the $100 a square foot range for, again, 150,000 square feet, you're in the $15 million range, right? And the reason I'm going there with these numbers, I'm just trying to think about the headache. It sounds like, I mean, I don't know. I'm putting it out there. Maybe you have case studies to back this up. It's pretty much sounds like a headache-free tenant.
That is, you nailed it, man. You absolutely nailed why industrial real estate is so attractive. So like real case study, a property that myself and 3 partners bought 2 years ago. It's a single tenant building that's leased to a Fortune 1000 oil and gas company. We have one single tenant in there, and they've got about 4 years left on their lease now. And I haven't been to that property since we bought it. I did a site inspection with our engineer, and that's the only time I've actually been to that property, because they take care of everything. Anything breaks down, they're responsible for taking care of it. Our rent comes in automatically, so we don't have to chase checks. We bought that for about $3 million, give or take. And compare that to a multifamily property of like a $3 million multifamily. Like, you're probably looking at, call it just 20 units, is using like a safe number of 150 grand a door. If you're $150,000 a door, you have 20 tenants. How many times do you have to go to that building for 20 residential tenants you're probably going to be having turnover every month or every other month? There's issues with things breaking down. It's just a lot more management intensive to look at a multifamily property versus an industrial one. That's not to say that multifamily isn't still an excellent investment. I know a lot of people that have made very, very good returns and become wealthy by investing in multifamily, but it's a lot more hands-on. And because my day-to-day job is being a broker, that's where my focus and attention goes. I can't be managing a 20-unit apartment building as easily as I can manage a single tenant industrial property. And Costco, Home Depot, Walmart, Amazon, FedEx, all these big companies, it is so much easier to manage those, particularly when you've got long-term leases in there, right? You buy a property with a 10-year tenant in there, and it's a Fortune 500 company, you might never have to go there. You might be able to put like a really easy property manager in there if you don't even want to do anything yourself. And it's very hands-off.
Experimentation. I always experiment. And the reason why is I'm always trying to find the best tool, the best method, and the best vehicle to help me get to my end goal. One of the tools that we use in the short-term rental space is Guesty for Hosts. Now, Experimentation, you know that I love to test things, and I wouldn't be sharing with you anything that I don't use myself. As a short-term rental superhost, Airbnb superhost, listings that we own and co-host at the same time, I can tell you that there's no better software that allows us to streamline our business. Right now, currently, there's actually 3 properties right now that are currently where guests are checking in, and I'm here with you, and I did not need to send in check-in instructions for these current properties, right? There are multiple ways that you can streamline your operation from on the front end and on the back end, from being able to create a website, from being able to get income reports for your team, to looking at statistics, to setting up auto reviews, to integrating your smart lock so that you don't have to sit here and send every day and remind yourself to send the passcodes for your smart locks. No, instead you can integrate directly the exact same way that you can actually send your cleaners a link so that they don't have to remind themselves when they need to go to cleanings. There's text reminders that go out. There's links that can go out for them. This is a tool that if you're looking to give a smooth experience for your team on the back end, it will truly reflect, and it does, for your guests on the front end. Make sure you go to host.guesty.com and use our unique link. Our unique link will be in our bio, in the show notes. If you're currently watching this, you'll see it right here at the bottom of my screen. Use this unique link so that you can tell Guesty that I sent you. You don't want to miss out on this. You need a PMS, property management software, in your business if you're looking to operate like a super host that you deserve to be, so that your guests can have the best experience that they deserve to have at your properties. Again, that host.guesty.com. Use our unique link that is here on the screen, in the bio, and in the show notes if you're listening to this, guys. Happy hosting. I guess that was going to be my next question, because we know in multifamily, there's an entire staff. I mean, if we're talking really large, right? If you're talking 1,000 units, 500, I mean, the big 300 units, and big is all relative depending on who's playing the game here. But, typically you factor in like the 8% of gross. You have people on salary on staff, part of your CapEx, right? So for triple net lease, do you still need a property management insight? And if so, what are they doing?
A lot less than a residential property manager would. So quite often it'd be if there's something major that happens, right? Like a sewer line backs up, or there's just something that the tenant isn't capable or wanting to handle themselves. The tenant still pays for this. That's the other beautiful part, is because it's a triple net lease. If the tenant calls the property manager and the property manager sends out a repair guy to fix something, that's all getting billed through to the tenant anyways, but the property manager can deal with it. But it's a lot less. But they're typically going to be a lot more hands-on from an operational and strategic standpoint. So a property manager on the commercial level, instead of just dealing with like the day-to-day issues of things breaking down and tenants having to do rent collection and deal with delinquencies and turnover new tenants, a good property manager will be more of a strategic partner with the owner, where they'll help them forecast projected expenses or things that might be coming up, or getting ahead of any potential issues. They become a lot more of a strategic partner versus just someone doing the day-to-day maintenance of overseeing that many tenants.
Excellent. And so how do you structure your team? So you mentioned, I think this is a good case study, a $3 million industrial property. Hey, I want to ask, what your cap rate looks like on that, or cash on cash return. Cause I'm kind of just, as you're saying all this, I'm like, this lean triple net lease, like, I don't even know what that looks like on a general ledger. Like, I'd love to see what the P&L looks like at a high level, but like, who's on your team? Are you paying the property manager as a contractor? Do you still take out a specific part of the gross that's made from the property? Is it the same structure here, or how are we dealing with this?
Both. So we've got one property where we've got a dozen tenants in it, roughly. So that one we have a dedicated property manager, just because there's more things that come up all the time, like just common area bathrooms, and there's issues that come up with that one. So we've got a dedicated property manager.
Industrial.
That one's actually that's an office retail property, actually.
Okay,
so
gotcha.
It's, main floor retail, second floor office. Yep. And there's just more issues that come up with that one. Everything else that we have is industrial, and we self-manage those ones. And it's a lot easier. Like it's so much more street, especially if you become very systematic. If you've got systems in place to deal with everything that comes up, it's a lot easier to do. So we'll still charge a management fee, but it's really just kind of a paper movement more than anything, with like one corporation paying another corporation for it. And it's not a large amount by any means. There's some companies that if they scale enough, they can have complete in-house property management where you can look after a couple million square feet worth of industrial inventory without having to have a large payroll, versus, and call it a couple million square feet, call that's like a couple $100 million worth of real estate. If you had a couple $100 million worth of apartments, you're going to have a huge team. Like that would be an enormous team. Whereas on industrial, you could run a couple $100 million portfolio with a pretty lean management system.
Awesome. So again, case study, going back to like, let's say that $3 million property, for context, to someone who might be listing, who might be persuaded and going into the space. Well, what kind of numbers are you looking at? Again, this can change from property to property. I think we're just trying to get an understanding of the kind of numbers that maybe you've seen from some of your clients, or some of your kind of doing due diligence and seeing what was typical. Are the cap rates a lot higher? Are they lower? Or what are you seeing when you're comparing this kind of product?
So on a cap rate basis, there's typically going to be about 150 to 200 basis point spread between multifamily and industrial. So if New York is an example, I'm guessing you're probably in that 4% cap range for multifamily. You're probably going to be in like that 5 to 5.5 for industrial. There is going to be a spread just because there's less competition. There's just less people. Like if you were to put up a multifamily property for sale in New York and you advertised it well, you might have 1,000 people that are all interested in buying that. Versus if you do the same thing with industrial and market it to everybody, it's going to be some small fraction of people that are just confident and have the ability and know that asset class well enough to invest in it. So there's less competition. Anytime there's less competition, you're just going to see upward pressure on that cap rate. It's interesting though. I've been doing this for a long time, and I know people that have done this both as investors as well as on the brokerage side. There's still, when you break it down over a long holding period, so call it just like a 10-year hold, you buy a multifamily property, you buy an industrial property. By the time you start factoring in appreciation and just cash flow, mortgage pay down. There's a lot of incentives on multifamily to get really lucrative financing packages, whereas on the industrial side, it's not nearly as competitive. So you're going to be paying a little bit more. I've actually found that the internal rate of return is actually pretty comparable. And internal rate of return, just to like really simplify for people that aren't familiar with it, that's just your average annual compounded return. So instead of having like 8% 1 year, it's basically you're getting 8% on average compounded throughout the term of the holding period. I've found that IRR is actually pretty similar. Aside from the anomalies where, multifamily, maybe a really hot market had 20% in appreciation. Well, that's going to distort that number versus maybe there's an industrial market that had 20% inflation. That will also make those numbers look different. But on average, over like a wide spectrum, industrial and multifamily is going to be pretty comparable from a yield standpoint. But it comes down to where do you want to be putting your money? I think multifamily is actually a really safe asset class. People are always going to need homes. We're undersupplied in housing inventory all over North America. So it's not like we have an oversupply. There's more tenants than there seems to be housing. So I think multifamily is a very safe asset. It just comes with a lot more management requirements. And I think that'd be the biggest thing that I would say separates multifamily from industrial. They're very comparable returns, but where do you want to be spending your time and where is your time best spent?
And money.
And money.
Yeah. So this is very interesting because what I hear is two different asset classes, pros and cons. They each have their pros and cons. Now, when you talk about industrial, I think we started talking about this in the beginning, and then we got into kind of the meat and potatoes. But looking at a macro level, when you look at the industrial, vertical in itself and the branches that it has, we talked about Amazon, we talked about e-commerce. Where do you think the opportunity is now? What kind of product, is it the warehouses that are now, there is a huge demand for it because there's, again, supply chain management, maybe some kind of bottleneck? Is it storage facilities, which I've heard do very well? Like, what do you see as or maybe some dominant pillars or even some recession proof kind of maybe within the asset class in itself? Like, we're going niche, right? Within industrial, what do you see as maybe a bulletproof or something that you see as on the uprise?
So maybe the best answer I could give to that is actually to break it down into different categories. So if you're an experienced industrial real estate investor, I think there's all sorts of opportunities that you can look for right now. But maybe instead of focusing on that, because I suspect if anyone's listening to this, they're probably just curious about how they could even get into industrial real estate. Right. And anyone that has that experience, they might just listen to what I'm saying and just dismiss and be like, we already know what we're going to do. So just, you can stop talking now. But I think for the people that are considering it, first thing that I'd say is consider partnering up with somebody in your local market. Find out someone that has done a few projects, maybe already has some assets under their belt in the specific market that you want to invest in. Not just like if you're in New York, I would myself personally, I'd be very reticent to invest in Denver. Or if you're in Denver, I'd be very reluctant to invest in Florida because you just don't know those markets nearly as well as you know your home market. So I would be more prone to invest in a market that you already know very well and find someone that has experience in that. And maybe you're the capital and they're the hands on the ground and they're the ones doing all the legwork to source a deal, organize it, put it all together, make sure it's stabilized. I think that there's a lot of benefit in partnering with someone early in your career until you get a really good understanding of the asset class. And there's a lot of opportunities out there. I really like self-storage right now. I've talked to some incredible self-storage operators that have taken that model from being that old school mom and pop to now being a very technologically involved asset where everything's done remotely and they can monitor everything and control everything without even having someone on the ground. So I think that that's really encouraging. I myself would consider looking at self-storage here in the near future just because of how far that's come from a technology standpoint. But even if I were to do that, I would still want to partner with someone that knows that self-storage, and self-storage could be representative not just of that narrow, super niche area, but just as investing as a whole. Unless you've got a really good understanding of exactly what you're investing in, and that includes all the pros, all the cons, all the potential pitfalls, all the downside risk, all the things that can go wrong, unless you've got a really good understanding on that, I myself would recommend partnering with someone that already has that expertise. And that could be someone that sourced a deal. Maybe there's a local distributor who owns a building and they want to do a sale lease back, but you just don't know how to do it yourself. See if there's someone that could partner with you. So those would be kind of like the main things that I'd recommend is start by investing in the market that you know really well. I just think that everything that I own is within a 20-minute drive of my office. And I feel very confident on that I can check on any of these assets if I have to in 20 minutes. If a tenant vacates, I know this market well. I know a lot of people. Hopefully I can backfill that if an issue comes up. I just know this market so well that I know what I'm buying and I know the pros and cons with it. I can't say the same thing about if I was going to invest in Houston. I just don't know that market nearly well enough. So I would recommend to someone, consider your local market. And if you can partner with somebody that either brings something to the table that you don't have. So like lawyers are awesome at this. Lawyers are fantastic partners to have because they bring that legal element where they're looking for things that you just don't see yourself. And I've got lawyers on as partners on some projects. I've got accountants on projects. I've got property managers. I've got an appraiser on one project. And I think that just having that well-rounded knowledge prevents you from making a mistake that you might have otherwise made. And maybe you still do make that mistake. I think that anytime there's real estate involved, there's an element of risk and there's always the possibility that something goes wrong. But if you're doing everything that you can to mitigate that risk, I think you're just putting yourself in the best position for success. So if you invest in your local market that you know really well and you can commit to knowing really well, it's an ongoing thing. You can't just say, well, I know New York really well and that's it. This is the market. I know New York really well, but I'm also going to be a student of the game. I'm going to follow all the big deals that happen. I'm going to follow trends and vacancy rates and absorption and prices per square foot and what people are coming in. And you make that a commitment that you're going to study that going forward. And then you partner with someone that also brings something to the table. I think that like your chances of success increase exponentially versus me saying, well, you know what, this industrial real estate sounds really neat. This Chad guy seems to be talking about something fun. I'm going to go buy a property on the other side of the world with a market that I don't know and without any help. There's the spectrum, right? That guy's going to have a very low likelihood of success versus the other guy that I described. I think he's going to have a high likelihood of success. Yeah,
for sure. Process driven. That's for sure.
Process driven. That's a great term.
Absolutely. So Chad, I mean, this is so interesting, as far as, how this has come kind of full circle. We talked about kind of like the demand, the marketplace. You talked about the different asset class. We went layers deeper. We went about what you're, frequently seeing in the marketplace yourself. And then we even got really granular into the weeds of, how the product is even priced and sourced and triple let leases. But we went all over the place, which was super. I guess if you were to give someone, I think you already did in some sense, but if you were to walk away and say, hey, this is why maybe you should add this to your asset class, what would be some of the reasons that you think that someone who maybe has, multifamily and maybe it works for them, but why would you even maybe, I don't know if you need to convince anybody if they listen to this, but why should someone consider it? Do you find that, people who invest into industrial also do only just industrial? Do you find that people actually add this into their portfolio as a balanced portfolio? And if so, maybe why should they consider it?
Great question on that. And you're right. I think that there is the variety there. There are some people that diversify. There are some people that focus just on one asset class. I think I could summarize it by identifying a few different points on why I like industrial. And I'd preface that by saying, I don't want to sell or convince anybody that they should invest in industrial. I actually think industrial real estate should scare the average investor because there are pitfalls where you can make a mistake and it can be devastating. So I would say that instead of me convincing somebody, they need to convince themselves on why they even want to consider it in the first place. And once they've convinced themselves that it's something they want to explore, they need to be able to commit to a long learning curve of getting themselves up to speed on it. Provided they're willing to do that, I will never go back to multifamily investing myself. I have zero interest in comparing that to what I've experienced in industrial. And there's a few things for it. Less competition. You just have less people chasing the same type of product. You've got steady returns. You've got long-term leases. Like in many cases, you can have 10 to 15 if it's a big tenant, but it's even common to have a 5 to 10-year lease for smaller tenants. So you've got longer-term leases. You have less turnover. They're less management intensive. And by and large, I feel that there's the legislation that's in place all across the world that on the residential side that protects tenants, and rightfully so. Like nobody wants to see a tenant thrown out in the middle of the night and in the middle of winter. But the legislation on the residential side is skewed heavily in favor of the tenants, whereas on the commercial and industrial side, it's predominantly just contract law.
It's B2B.
Yeah, it's B2B and it's contract law. So whatever the contract says is going to govern. Like you could make a contract with a residential tenant and you could have it say all kinds of things. But if it goes before a judge, the judge is going to say this isn't in line with what the legislation says. So it's just thrown out. On commercial and industrial, there's all sorts of remedies that you have as the landlord if the tenant doesn't pay their rent. The process of evicting a tenant, if it even comes to that, is a lot easier from a landlord standpoint. And a lot of these leases are written heavily in favor of a landlord's right to remedy. So all those reasons make it very appealing to me to do it. And I think ultimately it's just easier to scale. So if someone only wants to have one property and maybe it's like a retirement property, they go buy a 20-unit apartment building and they just manage it themselves and they do the day-to-day stuff, I think that's the best course of action. But if someone really wants to scale a portfolio and start building it and making it even larger, then it's very difficult to do that without a very elaborate system in residential. Whereas on the industrial side, you can scale a portfolio a lot easier.
Such a great answer. I got to ask you, this came up as you were answering, and I'm very curious because I've heard of this. I did some commercial work at the time, but I can't recall exactly what the name is. Maybe we were close when we were talking about triple net leases, but do owners ever structure a way to get a percentage of what the business is grossing?
Mm-hmm. Yeah, it's usually called percentage rent. It's a lot more common in retail. I can't think of any examples that would happen unless it was like a quasi retail use in an industrial building. But the percentage rent is actually quite common in retail. And the whole premise behind that is actually like very simple. It's the landlord is essentially giving the tenant lower rent in exchange for getting a percentage of their revenue. So there's mutual incentives for both of them to do well. The landlord wants the tenant to do well so that they make more rental income, and the tenant obviously just wants to grow their revenue as well. So it is a common practice in residential, in retail, but I haven't heard of it much in industrial.
Oh, interesting. That distinction again circles back. Yeah, that's interesting to me because to me that's you almost feel like a shareholder. So I feel like, if you're at playing at that level, if that company has a really good year, you made a lot more than the average real estate owner because now you're kind of like part owning a business. That's interesting. And when you say a retailer, do you have any examples of like what kind of businesses, just to have our listeners have some context as like what that would look like? Is that like a restaurant? Is that like
it can be the full spectrum. Like just picture a neighborhood shopping mall where you're going to have like a grocery store as the anchor. You're going to have hair salons and like a small restaurant in there, nail salons, all like they're just the typical service providers that service a neighborhood. And some of them push back too. I'm not a retail expert by any means, so I don't want to necessarily say that one thing is how it is, but a lot of retailers do tend to push back on that for reasons that are pretty obvious.
Yeah, you're eating a big piece of the pie as soon as you start to blow up. Right. But I like it as an investor. I like having the option and the opportunity. Listen, Chad, speaking of opportunity, I think we've all had the opportunity to listen to this and get a masterclass from you in the industrial space, which is so refreshing because we haven't had that. Now, if the listeners want to continue to tap into you, I know you have a really solid YouTube channel, Chad Griffiths, right? I mean, it's up there. I was watching some of the content there. You have a really nice team doing some of your designs. So it's really nice to see your quality content on there.
Yeah, thanks for that.
Which, of course, it's brought to you by investortalent.com. So we can appreciate that because we create a lot of content for real estate thought leaders like yourself. So kudos to you on that. But in addition to your YouTube channel, which is your first and last name, Chad Griffiths, right? And you being on LinkedIn, where else can people really tap in to you, or where else can even get in touch with you if they're thinking, hey, you know what, I'm from Alberta. What a small world. Maybe there's some business to be had, or even reaching out to you. What are some of the ways we can be in touch?
Yeah, LinkedIn is also great. I'm active on LinkedIn and usually go on there every day. So if they want to check out or connect with me on LinkedIn, that's always great. And my email is griffithscre@gmail.com. And I always reply to emails. It might take a day or two sometimes, depending on how busy I am, but I reply to every email.
Wow. Kudos to you, my friend, for mastering that. Well, man, I got to thank you so much. Another brother again from the motherland of Canada here, straight out of Alberta. This was super. Thank you so much for stepping into the lab, rolling up your sleeves and giving us the game. We appreciate it. And just like that, Experiment Nation, we are out. Thank you.